So it's the third anniversary of the Standard & Poor's 500 bottoming out. As we showed you, 102% higher. We've been lagging those markets, and we paired our gains somewhat today after Greece forced its debt holders to take an awfully big haircut. Darren Farwell is the Director of Wealth Management at Scotia McLeod, and he joins us for his take. Good to have you with us again.
It's great to be here.
What a way to go into the weekend.
Yeah, it was quite an interesting week. A lot of things happened, and an interesting way to end the week. It's always nice when these institutions that are insuring something actually decide to pay up.
Now, those who were willing to take that massive haircut have already seen the bonds that they've swapped trade substantially less than the face value. Is this over, or do we have more of the same when we talk about Spain and Portugal and some of the other members?
It seems that this is like the ever-ready bunny story that never goes away in Europe, and I suspect that we haven't seen the end of it. There's likely to be another emergency or another. But what we can really take from all of what's happened over the last number of months is whatever that emergency is, it seems like they're going to find a way to fight their way out of the box and keep the European Union going, keep the euro going. Okay,
but in the meantime, you're staying away from what is traditionally considered to be the safer places to be amidst that uncertainty, gold and government bonds?
Well, gold's got a couple of things going against it right now. First off, as that fear trade dissipates, as sort of the chance of a really disorderly unraveling of Europe goes away, that takes some of that fear trade out of gold, so it starts to trade down. So that's going against it. When you see the technicals, we've seen gold trade through its 20-day, its 50-day, 100-day, and 200-day moving averages just recently on the downside. So that's a negative. We don't see a collapse on gold because at the end of the day, there are negative real rates of return. That supports the price, but we could see it go lower.
Okay, you brought with you some stock picks here despite all of that. A CLF, by example.
Well, we like that because it's in the REIT space and you get some yield.
Okay, so which one is that? Because I've got Cliffs Natural Resources.
Oh, sorry, I'm sorry about that. Yeah, I thought I said CUF. Cliffs Natural Resources. We like the commodity side. I mean, at the end of the day, we don't feel that you're going to get a good trade in gold anymore. We don't think now that there's no real risk of a double-dip recession you're going to get a trade in bonds. You're certainly not staying in cash, so you've got to be in stocks. Which stocks are you going to be, commodities or dividend paying? Well, we'd like to be in commodities. That's why we have names like Cliff Resources. We have names like Suncor. We have names like Teck on the radar. And you want to be there with a little bit, but we'll add more if we can get some solid evidence.
You know, if I understand Cliffs correctly, this is iron ore, but it's also coal.
Yes, it's iron ore and coal.
And there is actually a dividend, a modest dividend.
There is a modest dividend, and it's U.S. dollars. So we like owning U.S. dollar plays. Whenever Canadian dollar goes over par, we like to buy some U.S. companies. Okay,
and now on the coal front, you did mention Teck Resources, so let's pull up Teck Class Bs in Canada. Would you pay the current price of $36.47 if you didn't already own it?
We would really like Teck below $36, but we don't mind these levels. But again, we wouldn't go and buy it right now because we're not convinced that we're in the solid growth mode you need for commodities to go higher.
I'm being told wait until after the 4th of July, largely because there's the technicals and the S&P 500. There's the prospect of a correction in the equity markets because they've run so far so fast since the start of the year. How do you feel about the timing of that? Forget that sell in May and go away. Apparently in July we're all back.
Sell in May is not a bad idea, but one of the things that does worry me a little bit, commodities, is we've got a very strong head and shoulders chart on the commodities, and it's breaking down on the other side. So that does make us hesitate a bit. But when you see numbers like coming out of the United States, with some really positive numbers in terms of jobs, and you start hearing stories about what's going on in the United States in terms of housing, it's not that prices are going up, but when someone bids for a property, there's more people out there bidding for it with you. So it's getting busier. And even today, I was in Mississauga visiting some accountants that I deal with, and they said they're doing their clients' taxes. And the people who own businesses are doing better. And it's that kind of evidence that makes me think that there could possibly be better growth here this year than we're anticipating.
You mentioned energy, Suncor specifically. Why do you like Suncor at this point? Are we expecting crude oil to trade in a fairly narrow band through the summer?
Wouldn't be surprised. And again, we're having a hard time predicting where the commodity prices are going. But you know, you've got an integrated oil company that's one of the best in the country, so we just own it because it's got that positioning.
Okay, so it's also got 1.25% dividend. Are there other opportunities? Like, it's already down 19% on the chart we're looking at here. As far as where it goes over the course of the next 12 months, the consensus is that it's probably fairly priced at about $44.
Yeah, as I said, most of the commodity stocks that we have on our radar screen, we already own a little bit of, and we're waiting to buy some more. And we didn't get all the evidence that we'd like today to buy some more, but we're ready to buy some. These are not bad prices. But to buy some, you really need to be convinced that we're going to get a little bit better growth than what we've seen. Because China, after all, did lower their growth forecasts. That's not helping things. What if they do it again? We could still see some weakness in those prices.
It seems like more of a psychological thing with China than actual fundamentals, because going from 8%, which they always overshot, down to 7.5%, which gives them a chance to overshoot again, that's still a remarkable growth rate.
It is, and let's face it, what are those numbers coming out of China really worth in terms of hard data? I don't know, but
Nobody
you're right.
knows.
It's do they know? It's psychological. The direction is lower, and I think that's the thing we take from it. So if the direction's lower again, then maybe we're going to see commodity prices not as firm as we'd like. So we're a little cautious on them, but ready to buy if we saw other indications that growth. If we saw some more data out of the United States, which supported the fact that their growth is going to be higher than we're targeting, again, you'd probably want to move into some commodity names pretty quickly.
Darren, great having you with us. Have a great weekend.
Yeah, you too.
Darren Farwell, Director of Wealth Management at Scotia McLeod. For further market analysis, join us this evening on Market Call tonight at 7 o'clock.